Welcome back to Portfolio, everyone. And in today's Saturday stock battle, we are doing a big comparison between Domino's Pizza and Papa John's. This was a highly requested comparison that I got down in the comments. So every single Saturday, we do a stock battle between two direct competitors in the market. We go over some key financial metrics to determine which one may be the better buy right now and which one may see better future growth moving forward. So in this week's battle, we are doing Domino's versus Papa John's. And like I said, we do this every single Saturday. So if you have two companies you'd like to see compared, they could be dividend stocks or growth stocks, please leave them down below in the comments and I will do a comparison, add them to the list, and very soon you will see a Saturday stock battle of those two companies. So in this week's video, we have two of the largest pizza distributors in North America, Domino's and Papa John's. These companies overall dominate their respective industry, and these companies have been head-to-head for years. So what we're going to do is take a look at their historical performance over the past 5 years, and then break down some of their current financial metrics to see which one we like right now. So as you know, everyone, I'm the Gen Z investor, and we post on this channel every single day about the stock market. We talk about different stocks you can buy, overall stock market performance, and any other big stock market news and headlines. So please like and subscribe, and we're going to get right into this battle. The first thing we got to do is take a look at their price charts, just to get an overall perspective of how this company is performing over the past year. Domino's Pizza, ticker symbol DPZ, is currently being traded around $419 a share, and on the 1-year chart, they were up around 81%. So very fast surge over the past 12 months. You can see here a steady upward decline over the past 12 months, and during the month of March, they did see a slight decline but have fully recovered and continue to grow. If we take a look at their competitor, Papa John's, currently being traded around $99 a share, is up 127% on the 12-month chart. So you can see here once again, very similar price chart, nice long-term growth over the past 12 months. If we look at a longer-term perspective and we see how these companies have performed compared to the overall market over the past 5 years, we're going to take a look at Domino's first. You can see here with dividends reinvested, over the past 5 years, Domino's has returned a total of 306% to investors, which has grossly outperformed their specific industry of only 13% and the overall market, which only brought back 87% to investors. So 5 years ago, Domino's would have returned 306% to date. If we compare that to Papa John's, with dividends reinvested, they have brought back a total of 56% over 5 years compared to the overall market of 87%. So Papa John's has actually underperformed the overall market and actually been grossly underperformed how Domino's did. Domino's brought back over 300% over the past 5 years to investors, and you can see here they grossly outperformed the overall market compared to Papa John's, who only brought back 56% total over the past 5 years. So that was a quick recap of how they've been performing. Now let's jump right into this comparison to see which one may be the better buy right now and which one has more solid financial statements at the current point in time. So what we do is we compare key metrics from the income statement, the balance sheet, and both of these companies actually do pay out a dividend, so we also compare their dividend safety. First thing we like to take a look at is how large these companies are, so we compare market cap. So Domino's is the larger company with a $16.3 billion market cap. Papa John's current market cap is around $3.27 billion. So why I include market cap is some people only invest in companies that are very large, so I do like to show market cap to give somewhat of a comparison in size of the two companies. So you can see here Domino's wins this first battle. They are the larger company, and they are somewhat more dominant over Papa John's with regard to market cap. Next thing to take a look at is some key income statement facts. Over the past 12 months, Domino's has brought in $3.76 billion of revenue compared to Papa John's $1.69 billion. So of course, Domino's is trading at a much higher market cap, so it is somewhat to be expected that their revenue is higher, but we have some other metrics down below that actually kind of compare them equally. So even though Domino's is the larger company, it will see more of a direct comparison later on. So they do win this battle, bringing in $3.76 billion of total revenue compared to Papa John's $1.69 billion. Next, of course, we looked at the top line of the income statement. Now we're going to take a look at and compare the bottom line, which is net income or profit. You can see here over the past 12 months, Domino's Pizza has brought in $456 million of profit compared to Papa John's only $27 million. So with regard to profit, Domino's Pizza wins once again, and they're bringing in much more total net income compared to Papa John's. And now, something that's more a little equal, even though Domino's is the larger company, let's take a look at profit margin. So how much income are these companies bringing in per dollar of revenue? You can see here profit margin for Domino's Pizza at around 12.13%, compared to a very small profit margin for Papa John's of 1.6%. So Domino's wins once again, and so far they're up 4-0 compared to Papa John's. They have a much higher profit margin, and for every dollar revenue, they are keeping around $12 as personal net income for the business. Moving on, the next metric we have to take a look at is how fast these companies are growing their revenue. So of course, currently Domino's brings in more revenue, but we have to take a look at revenue growth. If one company, even though they have smaller revenues right now, but are grossly growing their revenues at a much faster rate than the other, that one may be a better buy. But if you take a look here at the 3-year average revenue growth, you can see here Domino's has averaged around a 13% revenue growth over the past 3 years. Compared to Papa John's, it's actually showing a decline on average of 4% over the past 3 years in revenue. So Papa John's revenue is actually going on the decline around a 4% average over the past 3 years, compared to Domino's, which is rapidly growing revenue year over year, which is what you want to see from this growth stock and this nice dividend growth stock. So Domino's wins this battle once again. They're growing revenue at a much faster rate than Papa John's, and Papa John's actually has to improve because they're actually posting a decline in revenue average over the past 3 years. The next battle we have to take into account is the PE ratio. So if we were to buy these companies today, this is the forward PE for each respective company from Seeking Alpha. So the lower PE ratio wins because it just represents that you are buying into each company and you are spending less money per dollar of company earnings. So you can see here Domino's Pizza's forward PE is around 12.6 compared to Papa John's at 65.8. So if you were to buy one share of Domino's Pizza, you are getting more company earnings for a cheaper price compared to Papa John's, where you're paying a 65.8 forward PE ratio. Next, another key ratio that kind of compares these two companies, although they are of different market caps, is the price to sales ratio. Again, you want the lower ratio, which shows that the company may be a better buy compared to the other. And Papa John's 1.88 PS ratio beats Domino's Pizza's 4.37. So this is the first time Papa John's has won a battle. So Domino's Pizza has won the first 6 battles, and Papa John's has won the 7th. So they have the better price to sales ratio at the current valuation. Next is dividend yield. So these are both dividend growth companies. Their share price appreciation is kind of what leads the overall growth of the company, and they do pay a slight but growing dividend each and every year. So we'll take a look at their dividend yields. So with current yield, Papa John's wins this battle with a 0.9% dividend yield compared to Domino's Pizza 0.75% yield. So although these companies are yielding very small amounts, Papa John's does with this battle and slightly outperforms and slightly is beating Domino's with regard to current dividend yield. Take a look at dividend growth rate. So once again, it's nice to see these dividend yields, but we want to see how fast these companies are growing their dividend each and every year. Domino's Pizza has a 5-year dividend growth average of 21% compared to Papa John's 11.2%. So Domino's wins this battle. They are growing their dividend at a much faster rate than Papa John's. So although their dividend is slightly smaller at the current yield, they've done a nice job of growing their dividend at a faster rate over the past 5 years on average. And a 21% average dividend growth rate is spectacular. And if this company can maintain that dividend growth rate moving forward, investors will see nice compounding on their dividend income. Next is dividend safety. So although these companies are paying a smaller current yield and they've been growing them at a decent rate each and every year, how safe is that dividend? When you buy into companies and you buy in for some dividend income, you want to make sure that that dividend income can grow and it can grow consistently for years on end, and it's safe and sustainable. So this dividend safety rating is from Simply Safe Dividends, and this gives you an overall perspective on how safe a company's dividend is. So currently Domino's Pizza has a 55 dividend safety rating, which is very low, and that's considered borderline safe, compared to Papa John's 31, where their dividend is considered unsafe. So we want the higher dividend safety rating of the two. So Domino's Pizza wins this battle, but overall, both of these companies do not have safe dividends. A borderline safe and considered unsafe dividend from Papa John's are very risky. These are companies that may have to cut the dividend within the next 12 to 24 months. And it just shows that these companies, don't have the fundamentals, don't have the future prospects to continue to pay out and grow that dividend each and every year. Next thing we take a look at is payout ratio. So even though these companies have somewhat looking sustainable payout ratios, Simply Safe Dividend just believes that their dividends are still somewhat at risk. So this is earnings per share payout ratio. So how much of a dividend is being paid out per dollar of company earnings per share. And you can see here around 24.8% of net income is being paid out as a dividend for Domino's Pizza compared to close to 59% for Papa John's. So the lower payout ratio does win and is considered more sustainable, and that goes to Domino's Pizza with a 24.8% earnings per share payout ratio. So if we take a look so far, Domino's Pizza has been dominating Papa John's on this stock comparison, and right now if you're looking for a pizza company to invest in and you wanted to get into this type of industry and you saw there's a lot of growth potential, Domino's may be the one you want to take a look at over Papa John's. Moving on, we have to continue on. We have some key balance sheet metrics that we have to take a look at, which is the current ratio. So the current ratio shows a company's total current assets compared to their total current liabilities. And what this represents is, does the company have total current assets within the next 12 months to pay off all their short-term liabilities and their short-term debt that is going to come due within the next 12 months? So do they have the financial means currently to pay off all of their short-term debt within the next year? So the higher the ratio, the better. It just shows a company has more total current assets and they can deal with all their total current liabilities with ease. And what we want from growth companies is at least a current ratio of around 1.5. Anything 2 and higher is very good. And you can see here, Domino's Pizza has a current ratio of 2 compared to Papa John's 0.98. So Domino's Pizza does win this battle. They have the better current ratio, and they actually have a very nice sustainable current ratio of 2 right now. So with regard to their balance sheet, I believe Domino's Pizza will continue to operate very nicely without worry over the next 12 months. Papa John's will probably still survive, but they have a little bit more work to do to pay off their current short-term debt. Final debt we have to comparison we have to do is the debt to equity ratio, and both of these companies actually have negative equity. Both of these companies have more debt than total assets, so their net equity numbers on their balance sheets are negative. So I know I could have put the negative debt to equity ratio in this comparison, but I didn't want to do that. Both of these companies have negative debt to equity ratios. Both of these companies have more debt than assets, which for me is a personal red flag. I personally do not invest in any companies which have more debt than total assets. It just shows that there might be some instability with the company moving forward, and I believe that is what had a direct comparison with the dividend safety rating from Simply Safe Dividends. So although these companies are paying out, sustainable rates from their earnings per share, they have much more debt than total assets. So these companies need to really work on reducing their total long-term liabilities and total liabilities as a whole in order to get that debt to equity ratio positive, maintain more assets than liabilities in order to sustainably grow the business over the long term. So no one wins this battle. I'm not going to put a winner. I don't like investing in companies with, negative debt to equity ratios, and both of these companies have just that. So that was the direct comparison between Domino's Pizza and Papa John's, and Domino's Pizza was the clear winner of this battle, winning almost all of the battles. Papa John's slightly won out 2, and they won the PS ratio and the dividend yield. But overall, Domino's Pizza just shows to be the better company right now. And if you're really looking to getting into the pizza industry and you wanted one of these household name brand companies, take a look at both of them. Of course, you can do much more research. This was a very brief overall analysis. This was just top line ratios to determine which one right now kind of looks right off the bat as the better buy, and that would have to be Domino's. So if you have 2 companies that you want to see me compare in next week's battle, please leave them down in the comments below and I will take a look at them. We do a stock battle every single Saturday on this channel, and I will see you in tomorrow's video.